Since the March lows, DR Horton is up roughly 100%. Had you caught this dip when price came back to the previous all-time highs, you would be sitting pretty. These were the 2022 June lows. How could have anyone predicted this next and current leg higher in the face of rising interest rates? Well, you have a couple of macro themes taking place. Again, DR Horton, they build new homes. You had lumber prices coming down over the last 18 months. You had existing home buyers not wanting to sell and move into a new home because of interest rates. You still have supply constraints from a housing standpoint due to the pandemic, and taking those things into account, despite rising interest rates, you have DR Horton making new all-time highs. Now, a couple of things I want to point out on the monthly chart. You have this rallying price, a basing candle rally out. This is a monthly buyer's level. At the, say, 108 level. And what I like about this area as well, well, this green candle took out what was the previous highs. So if we draw another resistance support band, you're looking at something like this. So you got two confluences validating this level at 108. Now, before we continue with the analysis, let's get into this article. This article is coming from Market Beat. Is this the top for DR Horton stock? So they recently announced their earnings this past week. As dubious as the signals within the housing market, stocks like DR Horton have been rallying to new highs. The rally is driven by outperformance in the face of rising rates and falling mortgage demand, and it may continue. While third quarter results are more of the same outperformance, the signs of weakness continue to grow. Strength in the housing market is due to several factors outside the control of home builders, including interest rates. Now, you have Fed Powell coming out this week to announce interest rates, their stance on interest rates. Now, they took a pause a couple of months ago. They did mention during that time that they were anticipating 2 additional hikes. So this will be interesting this week. But I think the markets are anticipating a interest rate hike. Based on the outlook for the FOMC policy trajectory, that slowdown could begin over the summer and worsen as the year progresses. The FOMC is expected to hike rates by at least 25 basis points. So let's talk about their earnings. It was a blowout quarter. The company reported $9.73 billion in net revenue. That's 11% higher compared to last year. This contradicts an expectation of revenue to fall year over year and outpaces the consensus estimate by 1,500 basis points. On Wall Street, in the stock market, it's all about guidance. That dictates the next direction for price. So let's talk about DR Horton's guidance. It was favorable. The company expects revenue to be at least $34.2 billion compared to the previous high of $32.34 billion, which could be a cautious estimate. DR Horton's backlog is down 34% year over year despite a sharp uptick in new orders. New orders surged 37% during the quarter, likely due to the dip in interest rates seen during the period. But are down 5% year to date, which does not suggest strength. DR Horton's stock surged the week before Q3 release, setting a new all-time high. Post-release action has the market down from that high, showing significant resistance at this level. Without another catalyst, a move above 130 will be difficult. In this scenario, the stock could become range bound at current levels. All right, so this is has to be the daily chart, and at the 110 level. So let's go back to the analysis. We're going to go to the weekly chart, and price continues to respect the 13 and 26 simple weekly moving average. You can see that monthly bias level, how we had a rally in price, a couple of basing candles, and then a rally out. All right, let's go to the daily, and you can see how price sold off on earnings, hit the 13 simple moving average on the daily chart, and it's now sitting at 127.58. And that kind of matches the resistance support level at actually they had 110. All right, so a couple things to note. If you're a day trader, well, this was the opportunity to go long. If you are a swing trader, potentially you can wait for prices to breach, if they breach the 122.50 level, and move further down to retest the 115 level. If you are a swing trader, well, you're going to wait. You're going to go up in time frames, and this will be the level to get long. If price can pull back to potentially make new all-time highs. So things will be interesting. We see a market that's rallying year to date. We see interest rates at least taking a pause. We see the US dollar dropping. Typically, the markets don't bottom before a recession starts. Some say we're going to get another leg down in the stock market. I don't know what the second half is going to look like. The best thing that you and I can do is trade the charts. Thanks for watching. Subscribe. Please like the video.